So I wanted to do a video on stock selection for the wheel strategy. What I commonly see recommended are dividend stocks, ETF stocks, high implied volatility stocks, or growth stocks. I'm going to go over all of them and let you know at the end on what I prefer and what works for me. With dividend stocks, I commonly see these recommended. This is all data extracted from the options chain. These are all 30 days out contracts and with as closest as possible to a 30 delta. So if you look at the return on risk, you're looking at about 0.81% for Johnson & Johnson, which is 9.72% annualized. Then you got KO, return on risk is 0.85%. So annualized, that's 10.2%. So the main reason I don't like the dividend stocks is the return on risk is kind of low. I like to go for at least 1.4% if possible. Mainly because annually I can make 10 to 12% just by holding an index fund. So it doesn't make sense to all this trouble with selling contracts and managing your positions if you're going to make the same as you would just holding a ETF. Also, a lot of people say that dividend stocks are good because they pay dividends. So if you get assigned on the stock, you'll still get paid. But the dividends are not very high. As you can see, 2.48%. 2.84, 3.14. That's not a very big return per year. Now, if you look at ETFs, it's kind of the same thing. So these are both 31 days out to expiration. Delta closest to 30. The return on risk for SPY at this time, 0.86%, which is 10% annualized. So if you were to sell puts, you might as well just buy SPY and hold it. QQQ 1.27%. It's a little bit higher, 15.2%, 15.24% annualized. And then there's stocks with high implied volatility. So these are some trades that I got into and got stuck bag holding pen for a while. And this one, support, I actually luckily got out of it early enough where I'm not bag holding it, but it could have happened. So what's tempting about the high implied volatility is the return on risk is usually really high. So I think when I was selling a put on support, it was probably around 5% risk on return, which is a lot, at like, I would say probably a 5 delta, which is really far away from the money. And then I'll show you guys the chart of what happened. So this is what the chart looked like when I sold the put. And then there was some good news that came out about it. And it looked promising at the time. But it just continued to go down and down. And this is what it looks like today. So luckily I bought back the put that I sold and I wasn't assigned. So the mistake I made with support was I didn't technically want to own 100 shares of it. However, with Penn, I did want to own 100 shares. The return on risk was really high and it had a really nice chart. So I'll show you guys. When I first started selling puts on Penn, it looked like this. So just a nice steady uptrend without any major pullback. So when it went down to here, it seemed like a good price, and I got assigned around 113 the first time. But since then, it's been downtrending and hasn't stopped. Then there's also growth stocks, which I don't know if Apple and Microsoft are still considered growth stocks, but mainly what I look for are stocks that are well established, that you know will be around for a while. A plus if they're already in an index like SPY or the Dow. And one of the most important things that I look at is that the particular stock makes new highs every year. I think this is like the most important part. And typically I'll look at a 5-year time frame. So for example, Apple, if you look at the last 5 years, so these dotted lines represent years. So 1, 2, 3, 4, 5. Every year it's been making new highs. So no matter if you got a sign at the high of the last year, it would have come back and you would have been able to get rid of your shares in a covered call. And then if you look at Microsoft, this is like a perfect picture of a stock that you want to sell cash secured puts on. New highs every year, and not very volatile. Here's a well-known company, but one that I would avoid. This is Disney, and if you look at the years before, it didn't always make new highs every year. So for example, if you got assigned at this high here, you would have to have been holding it for, let's see, 1, 2, 3 years probably, maybe even 4 before you would have been able to get rid of your shares with covered calls. And a lot of people, for some reason, think that the airlines would be a good stock to sell cash secured puts on in the wheel strategy. And as you can see, it's been downtrending. The thing is, so after the pandemic, people thought it was a good deal. But if you look at the history, it's been in a downtrend for years. So not something I would want to own. And lastly, you want to make sure that you want to own 100 shares of that stock. So if you have a smaller account size, make sure you can afford to cover those 100 shares. And ideally, you want to have some diversity, so you don't want to have your entire account in one individual stock. So in conclusion, what's worked for me is stocks that are uptrending, well established, already in an index, especially making new highs every year, and that I want to own 100 shares of. I hope that helps, and I'll see you guys next time.